Hi, I'm Tammy from MaxiForex with your week in Forex. Today we will take a look at the market highlights for last week. The dollar enjoyed a strong rally that primarily stemmed from better than expected employment figures. The rally carried itself into Thursday before it began to weaken. At the beginning of the week, risk aversion returned to the market in the wake of the rating reduction in Greece, Dubai's development company losing $3.65 billion, and Japan's poor GDP print. For a closer look at the markets, we're joined by foreign exchange analyst Martin Smith. Welcome, Martin.
Hi, Tammy.
Let's jump right to the question that everyone is asking. Is the dollar rally sustainable?
Well, investors know that a big rally for the greenback is likely. But I think one data point on its own can't trigger the rally most traders are anticipating. So I, for one, don't believe that a strong dollar is here to stay.
Well, so then what triggered the dollar to turn bid?
Well, the positive employment data was the catalyst. I mean, traders then, of course, made the broad assumption that this will set the stage for the US Fed to start tightening fiscal policy, essentially raising rates.
Okay. So if this is the case, what would cause the dollar to firm?
Well, the market needs to see another round of positive economic data. Additionally, I would say more importantly as well, the language from Fed Chairman Bernanke needs to hint toward a possible rate increase.
This past week, following the USD rally and the positive employment data from the US, Ben Bernanke remarked that he is remaining committed to a low interest rate environment for an extended period.
Well, Chairman Bernanke is known to be an expert on the recovery from the Great Depression of the 30s. And based on analysis, one hindrance at that time was the Fed moved too quickly to raise rates, thus stymieing the recovery.
Well, we did see several central banks this week that did not raise their rates, but their currency still appreciated.
Well, correct. However, the key there, I think, was the accompanying statements. For example, the New Zealand Central Bank's accompanying statements, after keeping rates on hold at 2.5%, indicated that they might start raising rates by mid-2010. Also, they increased the forecast for GDP to expand. That in alone sent the Kiwis skyrocketing by nearly 3% over 2 days. We saw the same market reaction to the loonie when BOC Governor Carney eased his comments about concerns on the CAD's strength in light of recent positive economic news. The CAD then advanced 1.25%, while the euro and pound have been relatively flat.
So what do you anticipate for the market for this week?
Well, a fair amount of volatility, I imagine. I mean, year-end is always a tricky time to navigate the markets, let alone under these circumstances. Volumes will continue to be light, and I think risk aversion will remain in control.
Any final thoughts about the US FOMC announcing its rate decision on Thursday?
Well, we obviously don't expect the Fed to raise rates. That much we can say. The key, as we noted, will be in the verbiage. Certainly, Mr. Bernanke did not hint at any change forthcoming, and as we know, the Fed is always, if not particular, with their language. It should be noted that the Bank of America has reached an agreement with the Treasury to repay TARP funds, as well as Citi stating that they intend to repay the funds as well. Lastly, the FDIC is set to expire its debt guarantee for banks. Now, this is very important because it will test the market's risk appetite when debt is no longer backed by the US Treasury.
Well, thank you, Martin, for joining us once again.
Thank you.
And until next week, I'm Tammy, and be sure to visit us at maxiforex.ru.